Ira Epstein of Linn Associates with your financial market wrap-up for this Thursday, the 27th of June, 2019, and we're just after 3:20 p.m. Central Daylight Time, which means you're in the pause in the stock markets where between 3:15 p.m. and 3:30 p.m. the markets determine the settlement price. They close for that 15 minutes, reopen at 3:30 to 4 o'clock. So these will be the settlement prices. Now, the big thing hanging over the market is going to be Saturday's meeting between Presidents Trump and Xi. And from the sounds of it, President Xi is, according to the newswire, is going to ask President Trump to remove the tariffs. Huawei has to be allowed to do business, so on and so forth, as a condition for returning to negotiations. The U.S. wants the negotiations to pick up right where they had left off with everything that had been agreed to, and they pick up from there. Doesn't sound to me like they're that close. So I don't know what you expect. Here's the dilemma. You're going to walk in on a thinner, normal summer Sunday night, and that's when the markets get a chance to react to it worldwide. Whoa, that's going to be interesting. So just be ready, because what you're seeing already in the market is volume is slipping away. Traders are concerned. You have the quarterly stocks report and the grains coming out tomorrow. That'll be an important figure. OPEC takes place not this week, the week right after we get the G20. It could be, I think, the end of next week. So I'm still looking for the exact dates. They seem to be all over the place. But OPEC is talking of at least extending their cuts, if not putting in deeper ones if the G20 results in the U.S. and China not getting any ground made on their negotiation. As you can see in the S&P on the weekly chart, you're down 22.5, 23 points for the week, so the market has settled back a little bit. No real damage there. You can see on the chart action we've paused on the break, but you haven't begun an up part, because what you've done here now is you've got higher lows, higher highs, but if the market takes out this 29.1450, you could all of a sudden have lower highs, lower lows, and the 18-day average, as I told you, is going to climb, and it's probably going to be right where the market opens, very close to it tomorrow. It's moving at the tune of about 10 to 15 points a day, so I'm just putting in where you're at now and guessing it's going to be near that 29.14 zone, so it'll be an interesting evening. When we look at Bollinger Bands, you're nowhere near them. They're narrowing in because suddenly the volatility of the market has turned itself off. We're going more or less sideways than anything else. The pattern is still bullish. The market has an upside bias because it's over the 18-day average, but if you should close under that number, then you got the 28.50, maybe the 28.20 levels to deal with. When you look at momentum, this is bothersome. The slow stochastic has turned itself down, which often leads to price and the 18-day average coming together. So as much as the market is doing well today with a higher close, I'm saying be careful. This market, all it has to do is hit the 18-day average when that occurs, and it's going to be near where the market has got that last break low of 29.14. As we take a look at the NASDAQ, same problem here. Momentum down. The difference in this market is you already have lower highs, lower lows. So losing the embedded reading, dropping down, I can see this market making an argument to get back to the 75.57 level, the 18-day average of closes. When you take a look at the Dow, you also have the pattern of lower highs, lower lows, the lost embedded reading. The question is, the 18-day average and price, do they come together? So far I'm seeing more reasons for these markets to have some slippage than to immediately go higher. When I take a look at the Russell, it's impressive. Look at how this market yesterday, we were talking about it, started holding the 18-day average. Now, the resistance above the market would be the 200 and the 100-day. The support, if it fell back, would be the lower Bollinger Band. You've got all kinds of divergence here. You got momentum pointing down. On the settlement yesterday at 15.21, you were under the 18-day average of closes, so bias was down. Today, the market reaches even under yesterday's low, comes back, and finishes up right near, as you can see, that 200-day moving average, putting the 100-day average as the next resistance. Whipsaw market that went back to the 18-day average, and it still hasn't, in my opinion, figured out what it wants to do. In the VIX, you're stuck also at that, what we call that line in the sand, another name for the 18-day average of closes. And you can see how the market just moved to it, and it's hugging it right now. Overbought, resistance, upper Bollinger Band, support the combination of the 100-day and the lower Bollinger Band. And as I said, this is a flip of the coin. Where are you going to go with China and the U.S.? Very difficult time. In the T-bonds, the market today put back in a bit of 20 points. It got down, held the 18-day average of close area. As you can see, I think you missed it by one tick. You did, just by a tick, and came back to close a bit higher. But again, how do you make anything out of this in front of this weekend's important events? I don't know. When you take a look at the 10-year notes, you slip down here too. Now, if we take a look, today's low was the 12 level. This low was the 14, so you've actually made the lower low. So you got a lower low, higher high, sideways action against the 18-day average. I'm going to say it again. Don't try to be a wise guy picking anything like that. You have no control what's going to happen as we get into the all-important U.S.-Chinese talks on Saturday. In the TLT, you're back to the sideways action, but you got lower highs, higher lows, no trend. Market is marking time. In the dollar index, a small rally in the market. Now, do people run to the dollar if there's nothing good out of China and the U.S.? That'll be a question. If it does, the 100-day and the 18-day between the 96.24 to 29 level, that'll be your resistance point. If the market breaks off that news, let's assume for whatever reason the market decides, it's bearish the dollar, the outcome of U.S. and China, well, then you're looking maybe at going back to the 95.30 level. The flip-flop is all true of the eurocurrency because they're just mirroring each other. This market made a near-term top, pulling back, support between the 100-day and the 18-day average of closes, not trending. You have a lower and low, higher high, overbought. The British pound's knocking on the door, I think, of new sell signals, getting under 127.09 today and settling, from the looks of it, under the 18-day average, puts the bears back in control unless you get over today's high. If you get over today's high, then I'll think differently of that. Where could that put the market? Well, the potential's there for the lower Bollinger Band. In the Japanese yen, notice how the market quickly pulled back. This was yesterday's action. Here's that 18-day average, that line in the sand. Notice what the market did. It pulled right back to it, hit it, and then came back and settled over it, just slightly by about 10 points or so. But you're getting neutral. So many markets are just seeing, I think, traders come out of them, and you're back to a neutral stance all over the place, which makes a lot of sense. Now, here's something that makes no sense at all. If you take a look, you're down 25% today in Bitcoin prices. You talk about craziness. Yesterday, you were up 22%. So you went from 13,885 to today you're at 10,395. Now, if you think you can handle that risk, great. I think they did a lot of damage to themselves as a futures market by having that extreme volatility today. That's what you call rock and roll. Now, if you also take a look, you had 1 day over the upper Bollinger Band, 2 days over the band, 3 days over the band, your fourth day. What do we talk about? It's rare that you go more than 5. So here's 1 day, and you close 96.25 under the Bollinger Band. Day 1 over the band, day 2 over the band, day 3 over the band, got it? 4, and bingo. That's why I say you stretch those things out. And this market didn't just gap lower. It worked its way. So you've got to protect yourself and learn how to use these Bollinger Bands, and that's why I have my charting course. It does its best. I'm not saying I'm the world's greatest, but it certainly does its best in explaining it in ways you haven't seen before. When we look at Brent versus WTI crude, as you can see, you've dropped about $3 in the spread differential in no time at all. You can take a look and see where your Brent is. And now you got to move to the September, by the way. The last trading day is right upon us for the August contract. And notice how you're just riding this Bollinger Band overbought in an uptrend, resistance between the upper band 6604 and 6650, let's say the 100-day average of closes. You're in an area where there's some profit taking, and rightly so. Traders are concerned about so much. They've got the Iranian treaty to deal with, still in position between Europe and Iran, and as of this weekend, Iran may be in violation of it if it decides to produce more uranium. Iran, I read their statement, they want Europe to give them the money for the lost oil sales. Yeah, that's going to happen. No chance. So where do we go on that? Then we take a look at August WTI crude oil. You can see you're right at the resistance point in the market. Got to pay attention there. You've been in an uptrend, but you're in resistance right now. In the gasoline, this is called riding that band. You're doing it again. You've gotten over the key number of the 100-day average. What was resistance on the way up is often support if the market elects to pull back a little bit here. So just keep your eyes on that zone. And of course, natural gas, well, we're into the 90-degree temperatures. We did have a draw today, actually a build, of I think it was 98 billion cubic feet. It wasn't enough to do much. You went back to that 18-day average and you're sort of stalled there. But the important part to me on the chart is you had an embedded reading, you lost it, and the market worked its way back to the 18-day average of closes, and that's where it stalled out. And it's often a warning sign if one is in a position that the market's going to make a move back up to that neutral line. I wish I could say it was all the time. I'd be the richest guy in the world, but it is something that I see, and it happens often. You know, when I talk about this, I've already written my market research tonight, this afternoon for my readers tonight. Not a hard day to write because there's so much about China. Now, my research starts with a morning subscriber video. Then, and by the way, I have different levels to my research. Some people just want the video. They find that's enough. Others just want my commentary, no trade recommendations. And others yet want all that I have to offer with the trade, the videos, and that. So I offer 3 different packages. They go anywhere from $60 every 30 days down to $7.95 for 30 days. So you get to work with it. You learn a lot. That's what I like to do. I like to teach. I like to put you on a path that I think makes some sense with trading philosophies. What you do with them, that's up to you. If you'd like to see what I do and how I do it, simply go to our website, sign up for a free trial, and we'll be sure to take care of you. You can always call my staff. They'll work with you as well. I'm Ira Epstein. You have a great day, and I'll see you tomorrow.